In this presentation, we'll take a look at entering data related to a bank reconciliation after having using bank feeds to enter the data directly into QuickBooks. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. Now the first thing we want to address is you might be thinking, why do I need to do a bank reconciliation when I got the data directly from the bank, right? A bank reconciliation is going to be comparing the bank data, which is basically the bank statement, to our data in QuickBooks. However, in this format, we took our data from QuickBooks in essence directly from the bank statement, not really the bank statement, but the bank feeds, which is the same data that is constructing the bank statement. So why do I need that verification? Normally, you'll recall what we do is we enter the information into our books. If we jump into our flowchart, this is QuickBooks Desktop, just to look at the flowchart. That would mean we would typically enter typically a full cycle in the vendor section, the customer section, and at the end of each cycle, typically we would have a check. We would be writing the check from our books and entering it without or independent from the bank. And we would deposit checks without or independent from the bank. Then when we would get the bank statement and basically double check that the bank statement ties into our statement. Note if you're on a cash basis system, however, and if you're on a cash basis which you are reliant on the bank feeds, this is not the case. We're not doing basically this whole thing. We're just waiting for the deposits and the checks to clear the bank and then pulling that information from the bank. Therefore, why would I need to reconcile our books to the bank books when all the information came from the bank? Well, we still need to do it. The result will be different, however, because what's going to happen here is we're going to pull information from the bank. We just want to make sure that we don't have duplicate information or that for some reason something got deleted and we didn't include that information. So rather than the bank reconciliation being something that's going to be reconciling two independent, basically input sources, which would be a better system for verification that everything is correct, because that would be two independent sources that we're tying together to show. We still need to do it even though we're not going to get that level of verification because we're double checking to see that we didn't double input something or not input something from the bank, completely miss something. So we still need to do that bank reconciliation. What do we expect to happen after the end of the bank reconciliation? For that, let's take a look first at the bank reconciliation we made in a prior month where we had the full service bookkeeping system. So if we had a full service bookkeeping system and we did a bank reconciliation, it would look something like this within QuickBooks. QuickBooks makes a very long, kind of overly tedious bank reconciliation, but the core of the bank reconciliation is we're going to have the statement balance, which would tie out to the bank statement, and then we would have the register balance, which would be the book balance, which is going to tie out to our books. And we need to reconcile the two, and the reconciling items will be these items. So there's going to be a difference between what's on the bank, what's on the books. Then we're going to have to reconcile it with these items. We want to know more detail about them, and QuickBooks puts them down below. The more detail, unclear checks and payments are going to be these. These are the actual items that we know that we wrote, checks and payments, which have not yet cleared the bank. So these are things that happened in the month that we are reconciling, but had not yet cleared the bank. And then these are deposits that we know that we had input into our system because we put them into the bank, but they had not yet cleared the bank, therefore are not showing up on the bank statement. There's a timing difference there. And that timing difference is going to be typically the purpose of the bank reconciliation, or those are the items that are going to allow us to know that we entered exactly, our our bank account ties out to the bank statement because we know exactly what we're off by. Now, in our case, what's going to happen here is we're not going to have these timing differences. Why? Because we didn't enter them into our system, right? We just waited till they cleared the bank and then entered them from the bank. So what's going to happen on our system is basically these two numbers should not be different, really. We should have the bank statement number should be the same as the register number, and we're just basically doing the bank reconciliation to make sure that that is indeed the case. We have nothing to actually reconcile because they should be the exact same numbers. We're just basically double checking that we didn't have a data input error and that we omitted something or input something 2 times. All right, now let's jump back over to our QuickBooks Online file. Let's open up our report. That's going to be the balance sheet report. So I'm going to open up the reports down below. I'm going to be opening up the balance sheet report. Then I'm going to change the dates up top. I'm going to be going from 01/01/20 to, let's make it 03/31/20. That's going to be, I've made 03/31/20. We're going to be reconciling the month of March. So the month of March. And in the month, I'm going to close up, let's right click on the tab up top, duplicate the tab up top. Now I'm going to close up the old hamburger. I'm going to hold down control and I'm going to scroll up a little bit so we get to that 125 spot. We're at the 125. So as of March 31st, we have a balance on the register of the 189, 421.09. If we go to our bank statement, we have the ending balance of 197.28.54. Now again, you would kind of expect these two to be the same given the fact there shouldn't be a timing difference. So let's do the bank reconciliation and see what the difference is. We're going to go back into QuickBooks. We're going to go then to the first tab here. Let's go back to the first tab, hold down control, scroll down a bit back to that 100%. We're then going to go down to the accounting and we're going to look on the reconcile tab. So you want to be on the second tab. That's going to be the reconcile tab. We're going to enter a bank reconciliation. So as you do so, you want to be checking off the checking account. And then we're going to, in our situation, we're going to have the beginning balance of the 105,811.54. Now, if you're just entering this data basically from scratch, when you set up the checking account, you can set up the beginning balance as the beginning balance so you can kind of test this out. If you're working along and you haven't entered like the 2 months of data prior to this, you could install the checking account and put the beginning balance here. In other words, you would set up in the chart of accounts, add a new account, which would be the checking account. So you'd add the new account, you'd make this a bank account, and then you'd have a beginning balance item down here, and you can put that beginning balance in. So I'm going to close this back out. We're going to go back to the accounting, and we're then going to go to the reconcile tab, reconciliation. We're going to be in the checking account. So we're starting off at the 105,811. The ending balance, according to our bank statement, is 197.28.54. So 190,728.54. Let's just double check that. 190,728.54, right as of 3/31/20. That's going to be the date of our bank statement, 3/31/20. So I'm going to go back over and we're going to start the reconciliation process. Now in the reconciliation, I'm going to close up the hamburger. We're just basically tying out what is on the bank statement and what is on the books. So basically, once this number in essence gets to 0, then you're reconciled. Now note how easy this is in this kind of system when you're on a complete cash basis using the bank feeds. It's already tied out. Why is that? Because you'll recall whenever we entered something in the bank feeds, you'll remember it showed up in the register as basically cleared, but not yet reconciled. We didn't do the reconciliation for it. And that means when it pulls over into all the items that we automatically put in through the bank feeds, when they pull over in here, you can see that they're in there by the bank feed, manually added from the bank feed here. And then they're already checked off for us. QuickBooks is saying, hey, I already know this one. So if I unchecked this one right here, the 65,000, note that this 0 will be out of balance. So, right, it's out of balance by 65. Then I check back on it and we're okay. So again, if you do everything kind of correct properly with the bank feeds, the reconciliation should be really easy to do. What it's going to do is just give you a double check to make sure that something didn't get entered improperly. And we can also see why it is here that we did not reconcile or we did not tie out basically our ending balance on the balance sheet, which was in a balance sheet on our balance sheet as of this same point in time, 189,421.09. Why is that? Because the first 2 months of data we had put in place using a full service system, which means we had outstanding checks at the end of the last time period, as we discussed in this bank reconciliation. So we had these outstanding items that were reconciling items at the end of our last time period, and that's going to be this 1307.45. So if we look at our difference then in the current system, we are currently at, let's just do some little calculation here. Pull out the trusty calculator. We're at the 189,421.09 minus, and then if we go to the bank statement, minus the 190,728.54. See, that's the 1307.45, right? And that's what we were out of balance by in the prior system. So obviously these didn't clear because they would have cleared in actual practice, hopefully, if these were outstanding checks and deposits and we were running the same system through the process. These outstanding items would have cleared in March. So this is February, they would have cleared in March. But what we did is we just entered the same data in for March and April, just so we can do the comparison between the 2 months on a cash basis, so we don't have these items clearing. So that's going to be the difference. These are still outstanding. They were outstanding last time. They're outstanding this time. If you were to use this system from scratch, you would never have any outstanding items, and therefore your bank statement here would be tying out to your books all the time. So that's going to be one of the benefits. It's really going to be really easy if you're able to, if you have the kind of system in which, or the kind of bookkeeping system, or the kind of business in which you can just depend on the bank. Now, again, that does come with its costs. It limits the information, like we've looked at. You might not have as full reports. You're not having that double check on the statements, and you're not having a double check on the bank. You're completely dependent on the bank. If the bank makes an error, it is what it is. But the ease of it is a lot more easy. So note the bank reconciliation. We don't even have to go through and check everything off. I go in here, it's basically reconciled. So then what I'm going to do is I'm going to say I would like to finish this. And so once this is 0, you could simply go up and finish. It's basically done for us automatically. Also just note that if you do have a problem, what you would do then is go to I would go to payments. This shows the payments. This shows the deposits, and then all of them. And you would just go and check them off one by one. So if I went to the deposits, then I'd go to the bank statement and just check these off. You're just verifying them here. So here's the $65,000. I would make it green as I go. So I'd say I see it here. You're always going from the bank statement to the book. So here's the 65. Here's the 65. And then you're gonna do this all the way through. I'm gonna hold down Control, make it a little smaller so we can see it. And then I'm gonna go. Here's the 50, and then back over here. Here's the 50, and then I gotta go, and then I would make that green. Here's the 8438. Here's the 8438. And so this is what you actually kind of have to do in a full service bookkeeping system, is actually pretty much manually tie these out in the process. Then you'd go to the payments, do the same kind of thing. You have a bit more verification with the payments, because you typically have names possibly for them. And if you have check numbers, that makes it a little bit easier for the payments. Note that the time of the date will often be further off, however. Well, they may not be off because these came directly from the bank statement. So if it was a full service practice, the dates would be off, but the dates would even tie out here pretty much. So it should be easier to do. So I'm going to bring this over. There's the 12,000. Here's the 16. So here's the 16,000. And just remember that these dates that we're looking at are not the dates that we actually, if it was a check that was written, not the date we wrote the check. This is the date that it cleared the bank. And if it's a check, that could be a significant difference, right? There could be a big timing difference depending on who we're dealing with. There's the 16,000, there's the 16,000, and there's the 7,000, and there's the 7,000. So you just go through this whole process. Note that if there is something on the bank statement that's not on our books, then you would think we would have to add it to our books unless the bank made an error, because we took all this information depending on the bank being correct. So you would think if it's on the bank statement, not on our book, you would think that we deleted a transaction that we shouldn't have somehow, and we need to add it back into the system possibly. If there's something in our books that's not in the bank statement, normally if you do a full service bookkeeping process, you would think that that would be the outstanding checks and deposits. However, if all your information is coming directly from the bank, you wouldn't expect to have any outstanding checks and deposits, and therefore what you would think would be the cause there is that you have a duplicate transaction. So if there's something if you're using straight bank feeds and you have something on your books that's not on the bank statement, it's probably a duplicate. And see if you somehow did the bank feeds twice, got it in there at two times, and check that out. Okay, so once this is then reconciled, then you're just going to go back up top and finish the reconciliation. We're going to go ahead and say done. So success, it's been reconciled. Note that if you had anything other than a 0 up top, you really don't want to reconcile. Even if it's like a penny, your reconciliation goes way down in value, because that penny, or if it's $1 or a few dollars usually, then that could be the cause of a lot of deposits and a lot of checks not being input, right? It could be the combination of checks and deposits that causes only a $3 difference. If it's 0, it's pretty unlikely that you have a lot of deposits and checks that match each other out to be 0. That's the point of the bank reconciliation. So if we can tie it out exactly, high assurance. If we tie it out to a couple dollars, the assurance, it's okay, I guess, but the assurance goes way down. Because that anything that we're off by could be a result of multiple transactions. So there we have that. Now let's go down and take a look at the reports. So if I go down to the reports on the left-hand side, we're looking for the reconciliation reports. I'll typically just type in the reconciliations. I'm going to type in reconciliation reports. Then we want the one we just made, and they usually put that up top. So we want the one that was in March. So I'm going to open that one up, close up the hamburger. Now they make this report, again, a lot longer than you kind of need it to make, but we have the statement balance. That's going to be the beginning balance. That's on the bank statement, so we kind of already had that information. We've got the checks that cleared, the 713. That's this amount. That's the decreases. We've got the increases, the 136,630. Here's the 136,630 on the bank statement. Then we have the ending balance, the 197,2854. There's the 197,2854, and this is kind of where the actual reconciliation starts, because this is what's on the bank statement. This is the difference. This is what's on the books, the 189,421.09. So that 189,421.09 then is what is on QuickBooks. So if we go back over to our reports, we can see that's the 189,421.09 in the balance sheet. And the difference then is going to be that 1,307.45. Again, if we had no prior information, there would be no difference. We would just check everything out, and these two numbers should be the same if we had been using bank feeds throughout the entire system. And then typically I would then go down and look at what those differences are. So if I scroll down, they're going to be down here. Now, if you do a full service bookkeeping, you'll have these timing differences, and this is what you're really concerned with. You'll note, again, all these happened in in February, not March, because that's when we did, the full service cycle. There are no differences in March. They're all from the prior month, and they add up to the actual checks. So you'd want to know exactly what the checks are, because typically if it was a check that we wrote that had not cleared the bank, then it will clear the bank next month. And I want to know what those checks are so we can then make sure that that is indeed the case and know exactly what the difference is. So that could be for the checks, which add up to these checks of 3006.2, and it could be the case for deposits, and minus the 1698.75. There's the 1307. And so if I scroll back up top, there is that difference of the 1307.45. Now, again, you're not going to have any difference if you simply rely on the bank statement and the bank feeds, but just note that that's a little bit different. You want to be able to understand a bank reconciliation in the system that it would be in a full service accounting, where you're checking two books and you will have timing differences for the checks and possibly the deposits, and in a system where you're taking the information directly from the bank statement, where you're not going to have a difference but still need the bank statement or the bank reconciliation simply to see that you didn't double input anything or not input something.